All right, what is up, YouTube? Today I'm going over a little bit of a different video. So, the first video I had posted was basically focusing on pretty self explanatory, but seller financing, what seller financing is, how I got my first deal, what it looks like, how good of a deal it was, etc. In my second video, I actually walked you through the seller finance flowchart. And today, what I want to do is I want to go through some of the primary KPIs you track and that you look at when actually analyzing a deal. So, without further ado, just go ahead and jump into it. Once you do your deal analysis, right? Of course, you want to identify your buy box, and then of course you want to actually run the numbers, do your underwriting on your pro forma, which is just a nice word for a deal analyzer or a calculator. And really, what you're doing is you want to make sure that that is going to be a profitable deal and hit your investment goals, right? Pretty self-explanatory. So, what metrics should you track, right? You will probably know most of these, but you probably won't know the intricacies of each. And you also probably will learn something here and there because at different points of your journey as an investor, you want to focus on different metrics, right? Cash flow is super important from the beginning, but if you have a lot of equity tied up in a property and you've owned it for quite some time, then instead of focusing on your cash on cash return, you might want to focus on return on equity. That's what I'm doing now. And that's really where I'm focused across my portfolio. And I'm no longer focusing on cash return. But yeah, so to jump right into it, the main KPIs to track when analyzing deals is number one, cash flow. Number two, cash on cash return. Number three, IRR, your internal rate of return, your cap rate or your capitalization rate. And then last but not least is your ROE or return on equity. So starting off with cash flow. Cash flow, very simply, is the amount of money that you have left over once all your expenses are paid after your income comes in, right? Basically, what you want to shoot for, it depends on your strategy, but a good, cash flow number when you're looking at like a long-term rental is $100 to $200 per unit. $200 per unit is hard to do, but it is totally possible. And $100 per unit is really the least. We really say 150 is, $150 per month per unit is the sweet spot, right? So what is cash flow? Cash flow is the amount of money left over from rental income after all expenses and mortgage payments have been deducted over the course of a year. It represents the actual profit generated by the rental property. We aim for at least 150 a month in cash flow per unit. And here's the major thing that's important when looking at cash flow is you're just looking at, pretty self-explanatory, but the profit, like it says, right? You're not, including in this metric, you're not including any appreciation, no equity pay down, no tax incentives. It's just cash flow. And coming off of cash flow is we have cash on cash return. So cash on cash return, very simply put, is how hard your cash is working for you, right? So let's say you put $100,000 cash into a deal. That's your down payment, that's your closing cost, that's rehab, that's the cost for tenant placement, everything. And you're all in for 100K. And then let's say your cash flow about $10,000 a year from that property. We'll annualize it. That means that you have a 10% cash on cash return. Boom. So what is cash on cash? The definition. Cash on cash is a metric used to evaluate the performance of a rental property. It measures the annual return on the actual cash invested. This metric is particularly useful because it focuses on the investor's cash flow relative to the cash investment, giving a clearer picture of the investment's efficiency and profitability. I like to think of the metric as how hard or how much work is my money actually doing on giving me returns. We aim for investments above 9%. That's assuming long-term rental. If it's a Airbnb or something else, you're going to want to be significantly higher. And these two metrics, meaning cash on cash return and cash flow, are the most important ones, but you should not evaluate a deal only looking at one of them. Instead, they impact each other. So you'll always need to compare them both to understand if a specific deal fits your criteria, right? Of course, it always comes down to your specific criteria, and you got to make sure that everything checks out and hits your long-term investment goals. Next is the IRR, or the internal rate of return. So what is it? The IRR is a financial metric used to evaluate the profitability of an investment in real estate. It represents the annualized rate of return at which the net present value, NPV, of all the cash flows, both incoming and outgoing, from the investment equals zero. Essentially, the IRR is the discount rate that makes the sum of the present value of future cash flows equal to initial investment. We aim for an IRR above 17%. Pretty self-explanatory. Obviously, it's a more in-depth KPI or metric to look at, and you'll see that once if you're thinking about doing a syndication, what they will show you most likely is IRR or ROI, one of those two. But now you know exactly what that is, right? The most important thing to note between cash on cash and IRR was a bunch of differences, but the biggest one is that the cash on cash only looks at cash in the deal versus how much profit out, right? That's where you want to be at a minimum 10%. And IRR is obviously a little bit different. IRR includes other factors, right? Other benefits of the investment that cash flow or cash on cash does not. And then we have our cap rate, or the capitalization rate, right? So the cap rate, commonly known as cap rate, is a metric used in real estate to evaluate the return on investment properties. It represents the expected annual return on a property expressed as a percentage of the property's value or purchase price. The cap rate helps investors compare the profitability of different real estate investments, right? So long story short, cap rates are used primarily for anything that is commercial, right? So you'll hear often, oh, that's a 7 cap, right? That's a 10 cap, that's a 2 cap. And really what you want to focus on looking at cap rate is you want to compress your cap rate, right, through a deal. So let's say you buy a deal, let's say like a 17 cap, and then you're able to sell it at a 5 cap. You would do very, very well on that deal. What you don't want to do is buy a deal at a 2 cap and then sell it at a 5 cap. You would most definitely be losing money in that scenario. If you have any questions on any of these metrics or anything, go ahead and leave a comment, and I will get back to everyone as soon as I can.